Good morning. As the sun rises over the nation's capital, millions of Americans begin their day, making choices that shape their financial futures. But behind the scenes, there's an institution quietly working to keep the country's economy on track. Let's break down the Federal Reserve, America's financial guardian. Established in 1913, the Fed was created to provide the nation with a safer, more flexible, and more stable monetary and financial system. Its influence reaches into every corner of our daily lives, even if we don't always notice it. The Fed is the nation's central bank, managing the money supply and setting interest rates to keep the economy stable. It acts as a bank for other banks, ensuring that the financial system runs smoothly and that money is available when and where it's needed. Its main tool? Adjusting the federal funds rate, which influences everything from car loans to job growth. When the Fed raises or lowers this key rate, it sets off a chain reaction, affecting how much it costs to borrow money, how much you earn on your savings, and even the prices you pay at the store. The Federal Open Market Committee, or FOMC, is the decision-making group, meeting 8 times a year to review economic data. These meetings are where the nation's top economic minds debate the best path forward, analyzing everything from employment numbers to global events. Their dual mandate, keep prices stable and maximize employment, means they're always balancing 2 critical goals. Stable prices help families plan for the future, while strong employment means more people can find good jobs and support their loved ones. When the Fed changes rates, it sends ripples through the entire financial system, impacting your credit cards, mortgages, and savings. A lower rate can make it easier to buy a home or start a business, while a higher rate can help cool off rising prices. Even a small rate change can mean big shifts for families and businesses. It can determine whether a small business expands or holds back, or whether a family decides to buy a new car or save for college. The Fed's decisions are about steering the economy clear of recession or runaway inflation. By carefully monitoring economic signals, the Fed tries to keep the economy growing at a healthy pace, avoiding the extremes that can hurt everyone. So, when you hear about an FOMC meeting, know it's not just economic jargon, it's about your financial life. The headlines may sound technical, but the outcomes affect your wallet, your job, and your future. Understanding the Fed helps you make sense of the forces shaping your daily life. It empowers you to make smarter decisions, whether you're saving for retirement, buying a home, or just trying to make ends meet. This story is about all of us, and it's worth following. The Federal Reserve may seem distant, but its actions touch every American, every day. By staying informed, you become an active participant in the nation's economic journey. Last month, the Federal Reserve once again captured the attention of the financial world. All eyes were on Washington as policymakers gathered for a pivotal meeting with investors, business leaders, and everyday Americans waiting to see what would happen next. In December, the Fed made a significant move. It announced a rate cut, sending ripples through markets and headlines across the country. The Federal Open Market Committee, or FOMC, decided to lower its benchmark interest rate by 1/4 of a percentage point, setting the new target range between 3.5% and 3.75%. This adjustment was closely watched as it signaled the Fed's ongoing response to shifting economic conditions. This marked the 3rd consecutive rate cut in recent months, a clear response to mounting evidence that the economy was losing momentum. Slower job growth, weaker manufacturing numbers, and cautious consumer spending all played a role in the Fed's decision. The central bank's goal was straightforward. By making borrowing less expensive, it hoped to encourage businesses to invest, consumers to spend, and ultimately keep the economy growing at a healthy pace. Lower rates can mean cheaper loans for homes, cars, and businesses, which can help fuel economic activity. Financial markets and economic experts watched the Fed's move with intense interest. Many saw it as a proactive step, an attempt to address potential problems before they could escalate into a full-blown crisis. The Fed was signaling its readiness to act quickly and decisively, but the decision was far from simple, and it certainly wasn't unanimous. Within the Fed, there were strong opinions on both sides of the debate. When the official meeting minutes were released, they revealed just how intense the discussions had been. Some officials expressed deep uncertainty about the best path forward, worried about the risks of both action and inaction. On one side, some policymakers and economists argued that the rate cut was necessary support for an economy showing signs of strain. On the other, skeptics worried that moving too quickly could create new risks or limit the Fed's options in the future. Ultimately, the December rate cut was about weighing complex risks and trying to interpret the often murky signals of the economy. Reading the economic tea leaves, as some say, the move demonstrated the Fed's willingness to act preemptively, showing that it would not wait for a crisis to unfold before stepping in. The story of this rate cut is really the story of that debate, of policymakers wrestling with uncertainty, trying to make the best decision for the country's economic future. And as the doors closed on that December meeting, the stage was set for the next chapter in the Fed's ongoing effort to guide the economy through uncertain times. Why did the Fed cut rates in December? It's a question that's been on the minds of economists, business owners, and everyday Americans alike. The answer isn't simple, but it starts with a careful reading of the economic signals, those so-called tea leaves that hint at what's coming next. The main reason was a cooling job market. For months, data showed that job creation was losing steam, and the pace of hiring was slowing down across many industries. Hiring slowed, unemployment ticked up, and the Fed's mandate to maximize employment was at risk. More people found themselves searching for work, and businesses hesitated to add new positions. Supporters of the cut saw it as insurance. Cheaper borrowing could help businesses keep hiring. Lower interest rates mean loans are more affordable, which can encourage companies to invest, expand, and retain workers. They wanted to act early, not wait for a crisis. By moving preemptively, the Fed hoped to cushion the economy before any downturn could take hold. Beyond jobs, economic uncertainty was growing. Global growth was sluggish, and consumer spending softened. International trade tensions and weak overseas demand added to the sense of caution. The risk was clear. Small cracks in the economy could quickly become bigger problems if left unaddressed. A slowdown in one area can ripple out, affecting confidence and spending everywhere. The Fed's move was calculated. Better to help now than scramble later. By acting decisively, they aimed to reassure markets and signal their commitment to stability. Officials aimed to stabilize growth and avoid recession. Their goal was to keep the economy on track, supporting both businesses and workers through uncertain times. They weren't just reacting, they were looking ahead, trying to anticipate challenges before they became crises. A little support now, they hoped, would prevent a lot of pain later. In the end, the Fed's decision was about protecting the future, making sure that today's warning signs didn't turn into tomorrow's problems. The rate cut passed, but consensus was elusive. FOMC members split into two camps, those wanting to support the slowing economy and those fearing inflation's return. The majority focused on rising unemployment and economic uncertainty, seeing a cut as insurance. The hawks worried inflation wasn't tamed and argued for patience. They feared cutting rates could reignite price increases. Some saw the slowdown as a healthy pause after rapid growth. The debate was about risk act now to protect jobs or wait to ensure inflation is truly under control. The Fed's challenge, balancing both threats. The December meeting saw rare formal dissents. Members disagreed from both ends of the spectrum. Hawks wanted to keep rates high, fearing inflation wasn't defeated. They argued for vigilance, even considering another hike if needed. Meanwhile, some doves felt the economy was weaker than the majority believed and wanted a bigger cut. This tug of war, some pushing for tighter policy, others for looser, was highly unusual. It reflected deep uncertainty about the economy's direction. Disagreements weren't just about cutting or holding, but about how aggressively to act. Even top experts struggled to interpret the mixed signals. The decision was finely balanced, with strong opinions on all sides. The Fed's job was made harder by missing data. thanks to a 43-day government shutdown. Key economic reports were delayed or missing, leaving officials to rely on private data and anecdotes. Some argued for patience. How could they act confidently without clear numbers? Others saw the uncertainty as a reason to cut rates, using anecdotal evidence as a warning sign. The data blackout deepened the committee's divide. The Fed had to make big decisions with a foggy view of the economy. It was a test of judgment under uncertainty. The shutdown didn't just disrupt data, it added political risk to the Fed's calculations. Economic growth slowed as federal workers went unpaid and projects stalled. For some policymakers, the shutdown was a clear argument for a rate cut to offset political damage. The Fed had to walk a fine line, respond to economic fallout without appearing political. Independence is key, but real-world events can't be ignored. The shutdown wasn't the only reason for the cut, but it tipped the scales for some. It amplified concerns about a slowing economy. Politics and economics collided, forcing the Fed to act. With the December cut done, what's next for the Fed? Many officials signaled a pause, waiting to see how the cuts play out. The next meeting is in late January, with fresh job and inflation data expected soon. If the economy weakens, more cuts could follow. If it rebounds, the Fed may hold or even hike. The Fed's path is data-dependent. Every report matters. Deep divisions remain, and uncertainty will continue. For now, the Fed is walking a tightrope, balancing growth and inflation risks. Their next move depends on which way the economy leans. So, how does all this affect you? When the Fed cuts rates, borrowing gets cheaper, lower payments on car loans, credit cards, and sometimes mortgages. Home ownership can become more affordable, and businesses may invest more. But savers earn less on their accounts. Your savings grow more slowly. The Fed's balancing act creates winners and losers in the short term. Its real goal: keep the economy healthy for everyone. Strong growth means more jobs and rising wages. That's why Fed decisions matter. They shape your financial reality. These aren't just numbers, they're choices that impact your daily life. Understanding the Fed helps you navigate your own financial future.